In this slideshow, we're going to talk about the determination of exchange rates. The International Monetary Fund, the IMF, was established in 1945. Its purpose was to promote exchange rate stability and thereby promote economic stability and economic growth in the world. In order to join the IMF, a country must contribute a certain amount of money, called a quota. The purpose of central banks generally is to promote monetary stability, although the Federal Reserve also has responsibility to promote full employment. The Eurozone has a central bank, called the European Central Bank, and its major objective is to set monetary policy for members of the Eurozone. There is a central bank for central banks, called the Bank for International Settlements, BIS. Its purpose is to promote stability of the banking system. China belongs to the international monetary system, but it tightly controls its currency, the yuan, or renminbi. China used to link its currency to the dollar, but now it links its currency to a basket of major currencies: the dollar, the euro, the yen, and the pound. The global financial crisis pushed China closer to liberalizing its policy, but it still controls the value of its currency. From the late 19th century until 1973, the world operated on a fixed exchange rate system known as the gold standard. The value of currencies was fixed in relation to gold. For example, the value of $1 was equal to 1/35th ounce of gold. In 1973, that system was replaced by the floating rate system that we have today. Countries have responded to the floating rate system in different ways. Some use the dollar or other hard currency as their currency. Some fix their currency in relation to the dollar. Some have less rigid peg rates. Some have crawling pegs. Some have floating rates within bands. Some have managed floating rates. And some have freely floating rates. Now let's talk about the concept of convertibility. Major currencies are fully convertible, meaning there are no restrictions in buying and selling them. They're known as hard currencies. For example, the dollar, the euro, the pound, and the yen. China has many restrictions, so its currency, the yuan, is not a hard currency. Countries with restrictions may use multiple exchange rates to control inflow and outflow of currencies. For example, to limit imports, it could require importers to pay a higher rate for a foreign currency than companies receiving foreign investments. Black markets for currencies often exist when governments control the legal market too tightly or manipulate rates at the expense of businesses or households. The rates in black markets are based on supply and demand, so they may provide a better idea of the real value of a currency than the legal market rate. There are four main economic factors in a country that determine the direction in which the value of its currency will move if allowed to float freely. Its inflation rate, its interest rate, its economic growth rate, and its balance of payments situation. A country's rate of inflation measures the extent to which its currency is losing purchasing power. If its rate of inflation is higher than the rate of inflation for a trading partner, then its currency is losing purchasing power at a greater rate than the currency of its trading partner. For example, if the USA has an inflation rate of 4% and Japan has an inflation rate of 2%, the dollar is losing purchasing power at a greater rate than the yen, so it should depreciate by about 2% against the yen. The concept underlying the influence of relative inflation rates on exchange rates is known as purchasing power parity. It is used to adjust a country's GDP per capita in terms of purchasing power. It is also used to construct indexes that determine if currencies are overvalued or undervalued, such as the Big Mac Index. A country's interest rate provides information on the cost of money in its economy. The rate used for this purpose is the rate paid by the central government to borrow in its own currency. For example, if the dollar interest rate is 2% and the euro interest rate is 3%, the euro should attract portfolio investors looking for a higher rate. Their demand for euros will strengthen the euro against the dollar, at least in the short term. A theory known as the Fisher effect states that the country with the higher interest rate will have a higher inflation rate. The reason is that investors include in their required rate of return a factor for inflation to protect them from the risk of losing money because of inflation, which is known as inflation risk. If investors require a 3% return after inflation, and if a country's inflation rate is 2%, then they will require an interest rate of 5%. So if investors require a 5% return in Australia and only 4% in Britain, it reflects the fact that Australia's inflation rate is 2%, whereas Britain's is only 1%, with interest rates determined as follows. Australia, required return plus inflation rate, 3%, required return plus 2% inflation rate equal 5%. In Britain, the required return plus the inflation rate, 3% required return and 1% inflation rate equal 4%. This assumes that other things are equal. The international Fisher effect predicts that the currency of a country with a lower interest rate will strengthen in the long term because it has a lower inflation rate. So in the above example of Australia and Britain, the British pound is expected to strengthen or appreciate against the Australian dollar in the long term, based on the difference in their interest rates. Note that the immediate effect of Australia's higher interest rate may be to attract portfolio investment to Australia, which would strengthen the Australian dollar in the short term, but in the long term, the negative effect of its higher inflation rate will prevail. The value of a currency will also be affected by a country's relative rate of economic growth. A country with a higher rate of economic growth will attract foreign direct investment, which will drive up the value of its currency. For example, if the USA has an economic growth rate of 2% and China has an economic growth rate of 7%, China should attract foreign direct investors looking for higher returns, and their demand for yuan will strengthen it if it is allowed to float freely. The value of a currency may be affected by the balance of payments. A chronic deficit in a country's current account, which includes its balance of trade, may cause investors to worry about its ability to continue financing this deficit. They may hesitate to invest more money in this country, or they may pull their money out, which is known as capital flight. When investors take their money out of a country, they sell its currency, which drives down the value of the currency. There are also political factors that influence the value of a country's currency. Political instability and social unrest will have negative effects. Revolutions, civil wars, and terrorism will also have negative effects. It doesn't take much to frighten away portfolio investment, which for good reason is known as hot money. Now take the quiz on this slideshow by clicking on the Quiz on Slideshow icon, which is right below the icon you clicked on to view this slideshow.